Welcome back to the Wall Street Podcast. Today we're diving into a recent research report on Apple Inc. It was released by Morgan Stanley just on July 23, 2025. The report's titled, Expecting a Solid Quarter, but Watching What's Around the Corner. It gives an updated financial outlook and, well, digs into some key uncertainties around Apple's stock.
Right. And this deep dive looks at Apple's projections for both the June and September quarters. It goes into the key drivers for products and services, revises some earnings estimates, and gives insights into those strategic overhangs. Things like the potential Section 232 tariffs, the upcoming DOJ versus Google remedy ruling, and of course, Apple's evolving AI strategy. It's worth noting, they're maintaining an overweight rating and keeping that $235 price target unchanged.
Okay, let's start with the June quarter then. Morgan Stanley seems to be expecting some upside, driven by product strength.
Yes, mainly across iPhone, iPad, and Mac. Their current revenue estimate for June is $90.7 billion. That's actually 2% above the street forecast. And for iPhone specifically, their revenue estimate is also 2% above consensus. They see upside in both shipments and, importantly, average selling prices, or ASPs. They're forecasting iPhone shipments at 47 million units. Though, interestingly, the June quarter builds actually imply shipments could be higher, maybe closer to 50.6 million.
And what about services? That's always a huge focus. There were some concerns about growth slowing down, but Morgan Stanley seems less worried.
Indeed. Actually, they seem quite optimistic. They're raising their June quarter services forecast by 60 basis points. They're now projecting 11.6% year-over-year growth. That's a good 90 basis points ahead of consensus.
Wow, okay. What's driving that positive surprise?
It looks like strong App Store growth, which finished the quarter right at that 11.6% year-over-year mark, and also improved Google advertising trends helping out. If this holds, it would be the 8th straight quarter of services revenue growing between 10 and 15% year-over-year. That consistency is pretty remarkable.
Definitely provides a solid base. You mentioned drivers. Are foreign exchange rates playing a part here too?
They are, yes. Morgan Stanley estimates FX could actually provide up to a 200 basis point tailwind year-over-year to June revenue. That's quite a bit higher than the 50 basis point headwind management guided for.
Big difference.
Huge. But, Morgan Stanley is being conservative here. They're only baking in about 50 basis points of FX tailwinds into their own forecast, just playing it cautious.
Understood. Okay, let's shift focus then. Looking ahead to the September quarter, Morgan Stanley expects growth to sort of bottom out. How do their numbers stack up against this street?
Right. They see September as the trough for growth this year. They've actually raised their September revenue and EPS estimates slightly to $96.5 billion and 1.61 cents. That incorporates some modest U.S. dollar tailwinds and stronger builds for Mac and iPad. They've also bumped up their gross margin forecast to 46.1%, up from 45.3%. But, and this is important, that explicitly includes $1.5 billion in estimated tariff costs.
Right, that $1.5 billion tariff cost, that sounds significant. How exactly does Morgan Stanley see that impacting gross margins?
Well, it directly hits their product gross margin estimates negatively by about 220 basis points. These are those potential Section 232 tariffs we mentioned. It basically means the U.S. could put tariffs on certain imports, maybe components or finished goods for national security reasons, increasing Apple's costs.
Ouch, 220 basis points is substantial.
It is. Despite that, though, the report thinks Apple's own guidance for the September quarter will probably bracket both Morgan Stanley's and the consensus expectations. They also think FY25 estimates might see a small, maybe 1-2% upward revision overall. And there's a flag here. If Apple's September guidance comes in surprisingly strong, it might imply they plan to raise prices for the iPhone 17, because Morgan Stanley's forecast already includes an 8% year-over-year jump in iPhone ASP. That's mainly from getting rid of the lower storage, cheaper models while keeping the price points the same for the remaining ones.
So customers essentially get pushed to higher price points.
Exactly. It lifts the average selling price.
Got it. So stepping back from the quarterly numbers, what are the key events coming up that investors really need to keep an eye on?
Okay, key dates to watch. First, the DOJ versus Google remedy trial ruling that's expected sometime by August. Then the iPhone 17 launch, typically in the week of September 8th. And finally, any further AI announcements from Apple. The timing on that is still a bit uncertain.
Let's talk about AI. The report suggests we shouldn't expect major updates on Apple Intelligence or Apple AI this quarter. Is that right?
That's correct. Morgan Stanley thinks investors might sometimes misinterpret Apple's AI goals by comparing them too directly to, say, Meta, Google, or Amazon.
How so? What's Apple's angle likely to be, according to the report?
They believe Apple's approach is probably less about competing head-on in search and more about building a broad platform.
Think new virtual assistant-like features baked right into the operating system. It would likely use a mix of Apple's own large language models, with Siri acting as the central command center, and potentially some white-label tech from leading AI labs they partner with.
And the goal of this AI strategy, how does it tie into enhancing products and ultimately monetization? The aim is definitely to make Apple's products and services better, more useful, and therefore more monetizable. Apple might not be topping the AI beneficiaries lists right now, but their core business is incredibly strong. That gives them breathing room to refine the AI strategy. Still, the expectation is we'll see some tangible progress in the coming months, and this ties back to their overall investment thesis. Morgan Stanley is keeping the overweight rating and that $235 target, because the core argument is about better monetizing Apple's massive user base, over 1.4 billion users. The key catalysts for that monetization, like an updated Siri, new AI partnerships, big product launches, maybe a sustained turnaround in China, or just faster revenue growth, they see those kicking in more heavily in fiscal 26.
Okay, let's drill down into some specifics. First, commentary module. Given those solid expectations for the June quarter, what are the main near-term uncertainties holding back investor sentiment, according to Morgan Stanley?
Right. The report flags three big overhangs that need more clarity. First, as we discussed, the Section 232 tariffs. Their implementation seems imminent, and Morgan Stanley's already put that $1.5 billion cost estimate into their September model.
Okay, tariffs first. What's second?
Second is that DOJ versus Google remedy ruling expected by August. This comes out of the big antitrust case against Google. The ruling will decide how Google might need to change its business, and crucially, it could impact those huge payments Google makes to Apple, over $20 billion a year, to be the default search on iPhones. That's a major uncertainty.
Definitely. And the third overhang.
Third is just the lack of a really detailed AI strategy from Apple yet. Apple Intelligence was a big step, yes, but investors want to see more tangible progress, maybe partnership announcements in the next few months to really get comfortable with Apple's AI position.
Understood. Moving to our second commentary module. Looking beyond the near term, what does the report pinpoint as the key driver for Apple's long-term outperformance? And why is it so critical?
The core driver, long-term, is absolutely better monetization of that enormous installed base again, over 1.4 billion users. The report argues the pieces are falling into place for faster growth, but it's weighted more towards fiscal year 2026.
What are those pieces?
Well, first, iPhone replacement cycles are getting longer, peaking around 5 years now. That suggests a lot of pent-up demand building. Second, new form factors could unlock that demand, things like a thinner phone this year, maybe a foldable next year, plus updated iPads, Macs, AirPods. Third, new software features, especially Apple Intelligence. It's launching fall 2025 or spring 2026, but it'll only be supported on maybe 20% of the current installed base. That creates a powerful incentive to upgrade your hardware.
The upgrade cycle driven by software.
Exactly. Plus, device pricing is expected to be a tailwind from 2026 onwards, and Apple probably has room to raise prices on some services too. Right now, Apple makes about $23 per user per month across everything, products and services combined. Morgan Stanley sees that as well below the potential ceiling for average revenue per user, or ARPU. If Apple can close even part of that gap, driven by new features, maybe premium service tiers, we're talking a huge opportunity, multi-billion-dollar potential there.
Okay, fascinating. Third commentary module. Let's focus on that DOJ versus Google ruling again. It's clearly a major event risk. What are the different scenarios Morgan Stanley lays out, and what could they mean financially for Apple?
Right. They outline a few possibilities. The base case scenario assumes the Judge Mehta, restricts Google's exclusivity for search on Apple devices, but still allows Google to pay Apple variable traffic acquisition costs, or TAC. This would probably mean Apple has to show users a search choice screen like they do in Europe now.
And the financial impact in that base case.
In that scenario, Morgan Stanley estimates only a small hit, maybe 1–2% downside to Apple's revenue and EPS. They think Apple could potentially use that choice screen to monetize different search partners, both traditional and AI-powered ones.
Okay, that's the base case. What about the bear case?
The bear case is much worse. That's if Judge Mehta completely forbids any payments from Google to Apple related to search placement. Remember, those payments are over $20 billion annually. If that happens, the report sees a major impact, specifically over 10% downside to Apple's EPS. That could easily push the stock back towards its April lows.
Wow, 10% EPS hit is massive.
It is, and it's unlikely Apple could make up all of that lost revenue just through a choice screen mechanism. However, one important point. Whatever the initial ruling is, Morgan Stanley expects it will be appealed. So any actual structural change to those Google TAC payments is probably still multiple years away, even in the bear case.
Right. The legal process takes time. Okay, so let's wrap this up. To summarize, Morgan Stanley's report suggests Apple is heading into its June quarter earnings looking pretty solid, especially with services strength, pointing to potential upside.
Exactly. But, and it's a significant but, you have to keep those overhangs firmly in mind. The AI strategy is still developing, the Section 232 tariffs are looming, and that DOJ versus Google ruling is a really pivotal event coming up soon.
So these factors definitely mean continued vigilance is needed, even with the positive outlook on Apple's long-term ability to drive growth by monetizing that huge user base through new products and eventually AI.
Right. Which leads to a key question for you as you think about this. Considering that potential long-term growth from AI and new product cycles on one hand versus the more immediate impact of these regulatory decisions and potential tariffs on the other, how might Apple's investment profile actually shift over the next, say, 12 to 18 months? And what opportunities or risks does that create for you?